I'm Kevin Degnan, Global Head of Structured Finance and Covered Bond Ratings at Fitch. Each year, our analysts and relationship managers conduct hundreds of one-on-one investor meetings, answering questions on a range of topics, from specific transaction performance to regulatory issues to ways we can enhance our research products. Unfortunately, we can't visit all investors, but we can provide market participants with insight into the types of questions investors are asking us and how our analysts are responding. With that in mind, in this new series of videos, I'll be talking with the heads of our various U.S. structured finance rating groups to find out what hot topics are currently on investors' minds and how Fitch is responding to their inquiries. With me today is Mike Dean. Mike is a managing director and co-head of the U.S. ABS group. Today we'll be focusing on credit card and student loan ABS. Welcome, Mike.
Thanks, Kevin.
It seems like credit card delinquencies and losses have been consistently hitting new lows for several years in a row. Are we finally at the bottom? And if so, do we expect a rapid decline in performance from here?
We believe we are at a plateau in terms of charge-offs and delinquencies. As you point out, though, we've been saying that for quite some time now, and performance continues to get better. In terms of charge-offs, we're right at 3%. We're almost at 1% for delinquencies. But for the rest of this year, we think we're going to see a return to more normal seasonality, where maybe we're just bouncing off the bottom for a while. That said, longer term, we do believe performance will begin to trend higher. But we believe it for both charge-offs and delinquencies. We believe they'll stay below historical norms for quite some time in the years to come.
Okay. How about on the competition front? In other asset classes, we're seeing heightened competition among lenders, and often that leads to a decline in credit quality. Is that something that we're seeing on the credit card ABS front? No,
there's very little incentive for banks to chase subprime borrowers in their card portfolios now. And in fact, there's actually significant disincentive through legislative actions that have taken place, particularly the Card Act, and through regulatory oversight with the FFIEC, with bank regulators in general, and with nowadays the CFPB as well. So we do think we'll see a more competitive environment. We're not going to go back to the late 90s, early 2000s, where you had the intense competitive environment where we had many more card programs and originators chasing subprime and niche players, regional players. We don't think we're going back to that route, given all the consolidation that's taken place. That said, we do continue to monitor things like solicitation rates and balance transfers and credit limit increases. The most recent lending officer survey did indicate some loosening on banks' card portfolios. We're just not seeing them show up into the card portfolios we monitor. You can see in the chart that the percentage of FICOs in these portfolios below 660 continues to come down, and has come down significantly since sort of the 30% range prior to the crisis.
Okay, very good. Let's transition over to student loans for a little bit. You can't open the Wall Street Journal or the New York Times without seeing a headline about the increases in college costs and the higher debt burdens that are being carried by college graduates. Is that are those headlines showing up in terms of impact on performance of the student loan ABS transactions that we're rating?
Yeah, the short answer is no. For all the headlines the student loan sector gets, and student loans outstanding and the debt burdens, I always believe it's important to put it in the ABS perspective. So of the $1.2 trillion in student loans that are outstanding, the vast majority sits on the federal government's balance sheet. So the biggest portion of that is the federal direct loan program, which hasn't been securitized and is not expected to be securitized anytime soon. The next biggest piece is the FELP program, which was shuttered in 2010 and will eventually go away. But there have been securitizations in that space. We've recently affirmed all of the AAA FELP or AAA ABS transactions backed by FELP collateral and assigned stable outlook. That was as a result of the resolution of the U.S. sovereign rating. So they're the two big government pieces of the pie. The third piece is our private student loans, which also they get their fair share of headlines. But again, in perspective, from an ABS perspective, overall private student loans make up about 15% of the 1.2 trillion. And only about 21% of that has been funded through the ABS markets over time. So all in all, that's about 3% of the total 1.2 trillion is private collateral that supports ABS transactions. So in that universe, it's really a mixed story. So transactions issued prior to the crisis performed much worse than we anticipated from a default and delinquency perspective. They were structured much more aggressively. So we've seen a number of downgrades in that space, and we'll continue to see downgrades. I just don't think at the same pace we saw over the last couple of years. The other side of the coin there is transactions issued since or during the crisis and since the crisis. Much higher credit quality collateral, and these are primarily from one big player, Sallie Mae, now Navient, and a handful of state agencies. So the credit quality of the collateral is much higher, much better. Higher proportion of co-signers, usually upwards of 90% now. And the structures are much stronger too. So it's usually a single tranche structure with 2 to 3 times enhancement than what the transactions used to go out. So from that perspective, we do expect private student loan ABS ratings to return to a more stable environment.
You mentioned the government as the big lender in the student loan space, and there's been a lot of talk in government student loan lending about relief programs for borrowers, pay as you earn, and debt forgiveness, and so on. Do you see any of those programs influencing the performance of the transactions that we rate, either FFELP or private label?
Yes, we actually, influencing is a good choice of words there. I think we actually think some of these initiatives and some of the programs proposed could be beneficial from an ABS perspective, both for FFELP or private student loan ABS. The programs in place and the ones proposed mostly fall under or would originate from the direct loan program, and students or borrowers that choose to participate in those would be consolidate out of existing loans, either FFELP or private, would be pulled in under the direct loan umbrella. So from a credit perspective, that could be positive for some of the at-risk borrowers in those pools. But from a prepayment perspective, which investors are also concerned about, you could see higher prepayments on those transactions. The only risk there would be probably some of the subordinate tranches that rely heavily on excess spread. But there's a long tail on those transactions, and they're covered in our stress scenarios.
Very good. Well, finally, as we wrap up, give us a little bit of your outlook for the U.S. credit card and student loan markets for the remainder of the year.
Sure. On the credit card side, given the stellar performance and the available enhancement in the multiple break-even multiples being so robust, we have a positive outlook for both collateral performance and stable to positive for ratings. Stable mostly for the AAA universe. Positive. We've assigned positive outlooks to many of the subordinate ratings as trust has come up for review, given the performance and the available enhancement. And we'll expect to continue to do so. We could see some upgrades as we go through the next round of reviews. We don't believe any of that additional enhancement that was added during the crisis is going to be removed. And we, as I said before, we expect the strong performance to continue for the next couple of years.
Very good. Very good. How about on the student loan front?
Yeah, on the student loan side, again, sort of a mixed story. So on the FFELP, we are at AAA stable, and most of the subordinates remain at high investment grade rating categories. On the private side, again, existing or pre-crisis issued transactions more negative from a collateral and a ratings perspective, and for private student loan ABS transaction issued since the crisis, during and since the crisis, we're stable from a ratings and collateral performance outlook.
Thanks, Mike, and thanks for your insight into our discussions with investors on credit card and student loan ABS.
Sure.
If you have any additional questions or for more information on the research Mike spoke about, contact us at the email address on your screen. Thanks for watching.